money manager in the studio in Cape Town. With me is Greg Flash from GCI. I don't know much about GCI, but we're talking about the GCI Balanced Plus Fund, it says here. Greg, thanks very much for coming. And GCI, first of all, give yourself a punt. And incidentally, it's the GCI Net Balanced Fund. GCI, first of all, please.
Thank you. Thanks for having me. GCI is a wealth manager, asset manager that began back in 2000.
So you've got a 15-year track record.
Yes. Jeff Cook was who started it back in 2000, Joburg based. His son Alex Cook entered the business around that time and then took over fully in about 2012. So the business has changed. It was one of the early broker funds kind of businesses. Now we've evolved into a separate wealth management business, a separate asset management business, and an asset consulting business.
So you've separated the different things. You're no longer broking. You are purely your division anyway. GCI Asset Management.
Yes.
It's quite interesting because you started in 2000. Of course, the market crashed. In March 2000, or started to. Didn't recover for quite a while.
No.
So well done to you for surviving those turbulent times.
Right. Well, I haven't been with them since that time, but it's been turbulent through many different periods. I actually joined the industry. I've got a different background. I'm an engineer, but I came in in 2007 and right at the top of the market and got a baptism of fire and saw just things go downhill for a long time.
I don't want to give you any sort of career advice, but South Africa needs more engineers and less fund managers. That's all I would say. So in the future, if you do decide that we have a skills shortage in the engineer section, please consider going back. But for now, let's talk about this fund. What is it?
This fund is a segregated mandated multi-managed fund that we launched just over a year ago. Currently, we use boutique managers in there. We have 2. So we've started with only 2, which is what we'll plan to move to 3 or 4. We like to partner with underlying managers in a segregated basis. Not all our funds are segregated. Some are fund of funds.
Yes.
But segregated gives us a way to have more transparency with the underlying managers. Also protects on various different kinds of risk that you encounter with boutiques. And that said, we don't only invest with boutiques, but we do have a passion to invest with boutiques.
Why? Because you get a better service from them, because you can establish more personal relationships with them, or is it because they have a better track record? I'm trying to find the article now that I picked up somewhere, and it was, I think, from FinWeek. Anyway, one of the financial publications saying that boutiques definitely outperform. I mean, that is a sweeping statement. What's your view?
I think boutiques, a lot of boutiques believe that they'll outperform because they're started by key individuals that came from big corporates that did well there and obviously did well financially, and they went off and left the boutique, left the corporate because they were tired of that corporate life and they wanted to do things their way.
Yeah.
If they can carry on that performance and build a team around them, that's great. And I think they can. Depends when they're launched, and there are some boutiques lately that have done extremely well, but they were the right type of fund or right type of investment style in the bull market that has worked. There are also other boutiques that you know of that maybe are bigger now and then are struggling, and I think that the main reason we like them is we like the passion. We do like the contact that we can get with a smaller manager.
They need to make money as well.
They need to make money.
They haven't got these fat 7-figure salaries that some of the bigger boys might be able to command.
Yeah, well, I think a lot of them will actually have a big piggy bank to a certain extent, so that they can keep their team there. One of my questions when I speak to boutique managers, if you take a hit of 50% on your assets under management, how long can you keep running before you have to cut your investment team?
Well, I'd have to say, sorry to interrupt, if they take a 50% hit on their assets under management, then they're going to go out of business immediately, because that is just that's irresponsible.
It would be irresponsible. It depends on flows. I'm saying if it's an outflows because somebody decides to take their money away, not on a market crash. What if it's a market crash and they fall less than others? Then that's fine. But
yes.
I'm talking about somebody decides to pull their money, and that's where the liquidity risks come in. So there's lots of risks involved with boutiques, but we like the upside as well. More risk, there's more value potentially, but you've got to watch them closely. You've got to understand operational risk, business risk, liquidity risk, key man risk. But you might get there's more alpha generation potential there than there is maybe in some of the bigger managers. Not all big managers. Some have got very good teams and they consistently outperform.
Yeah, I think the the fund management business in South Africa is very, very healthy. I mean, there's a couple of exceptions, but very, very few. I think we do rather well. This is the article I was talking about. It's in FinWeek. It says investment boutiques, high risk, high value, and it quotes you. It says here, when I started working, I was chasing a large and regular salary in an antidote to the years of student thrift, etc., etc. But what you're saying is, and I suppose it's like an advertorial. I'm not being nasty, but you're talking your own book here. Briefly, boutiques are hungry. What do you do with the GCI Met Balance Plus Fund? How do you approach it? How's it performed? What are you invested in at the moment?
Well, it's currently we've got two managers. We have two boutiques in there. We have Blue Alpha asset managers, and we have.
Isn't that a hedge fund company as well?
They do have hedge funds with them. Ace Mayer, is the key individual there. But Gary Quinn joined from Prudential, who has a very long track record, good track record. Also an engineer. And North Star Asset Management, headed up by Adrian Clayton, also ex of PSG Asset Management.
Yes.
He was CEO there, and before that another boutique. Those are the two that we have there. We're looking to add a third or a fourth. Both those managers are small-ish businesses, both of which have long track records, not necessarily with those businesses, obviously. So when we look at a boutique, they don't have long histories, but we need to know that investment team has performed in the past. So it's more about we're looking for expertise. Often people say experience, but experience can be 30 years of mediocre experience. I'm looking for expertise, very good experience.
Do you also attract yourself to people that think laterally? In other words, they are not bound by the convention of the massive infrastructure of a large fund manager. They have the ability and they are given the freedom to come up with something that's slightly different. I don't want to go mad and put everything into one stock or 50% into small caps or something like that, but have the ability and the freedom, as I said, to do something slightly different.
Yeah, I think that is true. I mean, that's the diversification we look for. We don't want the same kinds of manager. We want managers that have different styles and different beliefs in how the market works, but have proved that that's worked over time. So yes, they will be different. They'll have different backgrounds. There's been asset managers out there that are medical doctors. There are the certain managers.
Or
engineers. There's some that will only hire actuaries. There are some that will only look at auditors. Different, and they do see things differently. So
you never mentioned broadcaster, but anyway, carry on.
Broadcaster. Well, I think in offshore you sometimes get geography majors running large funds.
Do you know what? I've got a degree from University College London in geography. Again, carry on. Yeah.
So yes, we do look for difference, and that's the key. We're multi-managed business, and we look for diversification. And we don't make calls on asset allocation. We don't make calls on sector allocation, regional, and even you can see top 10 holdings in our portfolio.
We'll come to that in a second. Let's start with asset allocation if we can. Domestic cash 14%. Yeah. Interest rate rising environment, maybe that'll go up in the next couple of years. Domestic bonds 20 and a bit. Domestic real estate virtually nothing, just 3%. Equity 35%. Domestic equity 35%. Foreign equity 21%. So you're almost up to your maximum in foreign equity.
Yeah.
This is a big contentious point on Money Manager in the last few weeks. Some people are down at 10-15% because I think it's all done. It's saying others say, well, we're at 27. We're going to have to bring it back a bit because of the depreciation of the rand. Where do you stand?
Well, firstly, we don't make that call. That's our underlying manager calls. But what we do watch is that we're not too far away from peers. Or if we are, why is that happening and do we understand it? I think offshore weighting in 21% in equity, we feel very comfortable with. I think the long-term outlook for South Africa, even if the rand is grossly oversold and the US dollar is very strong, and it will turn around. And our managers don't look at things from a currency point of view. They look at it from a valuation point of view. Yeah. So if they are at full 25% weighting that they're allowed to be, we're comfortable there as well. I think the long term, this is a This is a product that is for Reg 28, your retirement money for long term. It must be thinking 5, 7, 10 years longer. And so it's hard to not have a full weighting in your risky assets. The 35% domestic is quite low.
Yes.
And so 56 total percent in equities
very low.
Is not totally low. If you look at peers, they're sitting around 60, depends on in a balanced fund kind of.
Has it reduced from a higher level in the last 6 months or so,
Yes,
given the elevated levels of the overseas markets?
Yes, it has. And you'll see some managers, well, not necessarily the offshore, just the offshore, the domestic guys have pulled their asset allocation down. The domestic equity side.
Nothing particularly, sorry to interrupt,
Yep.
we've only got 2 minutes left. We'll look at the top 10 holdings.
Yeah.
Nothing particularly controversial here. I mean, this looks like not boutiques, but
Yeah, it
large
does.
funds. I mean, you say you've only got 3% in domestic real estate, and your top 10
Yeah, it does come
is
through
Growth
that way.
Point.
Yeah.
It's a bit of an anomaly, isn't it?
Actually, you look at that top 10, and I looked down to see how far it goes. It's actually about 70 holdings.
Yeah.
And
they're all around two and
they
a
go
half to
smaller.
3, and then
and they go to smaller. With a
lower
multi-managed, you're going to end up with with more holdings and smaller holdings because you're diversifying. You're not seeing the offshores there, and you're not seeing some of the more interesting things. There's no resources that much in that top 10, and
There's
that's
none.
Not that, but there's a little further down, and that has hurt some of the managers.
Yeah.
Yeah, that top 10, people ask us about it. We didn't pick it. Underlying managers do, and we trust them to.
But you have to publish it, yeah.
We do have to publish it, and we have to speak to it only on the basis saying understand how they were picked and why they're there. When we speak to our managers, they need to justify why they picked a certain stock, not because we care what stock it is, but does it fit their investment process, their philosophy, and how they got to that point.
How's the fund been performing?
We've done all right. It's only a year old, and we're above peers. The benchmark is the peers, so we're quite happy with that. I mean,
Yes.
you can have bad luck when you start a fund at the wrong time. It can easily happen. We've been lucky, and we're above peers, and that's what we're happy
So when
with.
you lose money, it's bad luck. When you make money, it's your skill.
No, not at all. I think skill it's hard to separate skill from luck, and
Yeah.
I think it takes time. I think it's the underlying managers, and that's what we try and separate out. That's the key issue is
Yes.
what is luck and what's skill. And especially with markets as they are now, in maybe a turning point of the end of this 8-year bull market,
Yes.
then things are going to people are going to be shaken out, and you're going to see.
You're going to
are the
find
stock
people
pickers.
out. You're going
Yeah.
to find people out in the next couple of years, should what you've just sketched out actually occur. We're going to have to leave it there. But thanks very much for coming in, Greg. That's Greg Flash, who's the CIO of GCI Asset Management. We've been talking about the GCI Met Balanced Plus Fund. That's it for Money Manager.